Hi, my name is Kimberly McMillan, and I'm Director of Finance with the Foundation for the Mid-South. And I would like to welcome you to our financial training session today. The Foundation for the Mid-South is a regional community foundation. Our priority areas are community development, education, health and wellness, and wealth building. We work in the states of Arkansas, Louisiana, and Mississippi. The foundation has been in existence for over 20 years. We have been working to improve the lives of all Mid-Southerners. The financial training session that you're going to see today, it came about as a result of research that indicated that teachers was one of the most targeted groups by alternative financial services. And by alternative financial services, I mean payday loans, title loans, and cash advance businesses. As we started out doing our training sessions, we got requests from numerous superintendents and principals that we would expand our target market from just working with the teachers to working with other employees in the various schools. So now we make the training available to everyone. So we're so glad that you are here and going to be able to participate in this session today. We have two licensed financial planners that are going to be presenting to you. We have Willie Bell and Carl Snell with LPL Financial Group. After you've had a chance to view the session, if you have any questions about any of the information that is presented, please feel free to contact myself or one of the financial planners. Our information will be provided at the end of the session. Also, my contact information is also on the back of the Financial First Aid Toolkit. I hope the information that you received today is very useful, and good luck with improving your financial security. Thank you.
Hello, ladies and gentlemen. My name is Willie Bell. I'm here with Carl Snell. We're registered representatives with LPL Financial, and we are here today to talk about money. We're networking with the Foundation for the Mid-South in the area of wealth building. This is one of the 4 areas that they focus on. And our desire here today is to inspire and empower you through these ideas that we share to maximize your assets and minimize your liabilities. We'll talk, for example, about steps to a healthy financial future, and we'll talk about a financial aid toolkit that the foundation has put together. Now, first of all, there's a parable about a sermon on a mountain that a speaker gave at the conclusion of his speech. And so we're going to start our discussion with that parable. And it goes like this. It says, "He who hears these words of mine and put them into practice is like the wise builder, who when he built his house, he dug down deep and built his house on the rock." Right? "The rains came down, the streams rose, and the winds blew and beat against the house. And yet it did not fall, because it had its foundation on the rock. But everyone who hears these words of mine and do not put them into practice is like a foolish man who builds his house on sand. The rain came down, the streams rose, and the winds blew and beat against the house, and it fell with a great crash." So our desire is that when you hear this information, you will absorb it and put it into practice. We want you to know that the key to your better, brighter financial future is you. And so I think that this information is so tantamount, critical to you going forward, that I'm going to actually be reading most of the information on the financial aid toolkit that the foundation put together, right? If you look at the table of contents and go to page 1 of the toolkit, what you'll see there, it talks about building your wealth, right? It says, "Wealth is the abundance of valuable resources or material possessions. The process for obtaining or growing wealth is wealth building." Right? The Foundation for the Mid-South defines wealth building as a combination of financial competence, then that's understanding and practicing sound financial concepts and assets. And if you look to the left of that building wealth, there, it talks about assets. It defines assets. They are items or possessions that are owned that have economic value. Some of these could be checking or savings accounts, certificates of deposit, stocks and bonds, a home. Okay. Liabilities are debts or obligations. Now, money that is owed, such as credit card balances, mortgages on a home, student loans, auto loans, these are liabilities. And net worth is the difference between your assets, what you own, and liabilities, what you owe. Net worth is your equity or wealth, right? And there's a formula at the very bottom that's called a debt-to-income ratio. You'll see that further on over in the toolkit. As we talk about the toolkit, we go to page 2, and it shows the median household income for families. You know, it talks about white households, Hispanic, black, and it just gives you a picture to show you how there's a disparity as far as median household income in America. And these numbers were as of 2009. But if you look at it, white households had $113,149 compared to Hispanic, where it was $6,325, and black, $5,677. So what we're here today to talk about is you're getting on the path to financial security, and that's on page 3 of the toolkit. So again, it talks about wealth building being a long-term endeavor that requires individuals to make advantageous financial decisions both now and in the future. In order to build wealth, short and long-term planning is required. Goals must be set for each and must be specific and obtainable. You must determine how to use your financial resources to achieve your goals. For example, a short-term goal may be to establish an emergency fund. And the amount we have listed here is $1,500, and that could be over a span of the next 12 months. An example of a long-term goal is to have $250,000 saved towards your retirement in the next 20 years. Okay? The first thing you have to do is get ready. And when you get ready, what you want to do is you want to review your documents, right? So you can determine where you are. And in getting ready, the very first thing you have to do is set goals. When you set a goal, you see the first 4 words of that under set goals, it says write it down. You want to write your goals down. This is going to help you know where you're headed. And so once you evaluate your situation and implement your plan, you'll be able to chart your progress along the way. Okay? So you create a plan of action after you set your goals, you know, and one of those plan of actions, which Carl is going to talk about here shortly, is to pay off all your debt using what's called a debt snowball. And there are 2 forms of debt snowball that you can use. One of those is to pay off your smallest amount to the largest amount, paying off your smaller amount first and then moving upward. Carl will go into detail on that. Or you can start with your highest interest rate credit card. So either way, we want to encourage you to get out of debt. So as you go, you want to access your plan and your progress along the way. Now on page 4 also, there's some very key things that you should do, and you'll see this further in the toolkit. You want to use the tools on the following pages to get started on the path to financial security. You want to complete a personal financial statement. You'll see that on page 5. That's going to let you know where you are and where you need to go. Develop a monthly budget. We know John Maxwell says that a budget is telling your money where to go versus wondering where it went. So this budget is very important to helping you achieve your goal. Calculate your debt to income ratio and establish and maintain good credit scores. You'll see an example of a monthly budget on page 6. Please complete that. This budget plan by category, it uses an example with a $2,150 monthly income. And it breaks down the various categories and percentages on there as far as housing, auto, food, insurance, debts, entertainment, clothing, savings. But you can actually know where your money went. And you want to spend every penny on paper at the beginning of the month, right? Versus waiting till the end and wondering where your money went. And of course, on page 7, you'll see your debt to income ratio formula. You take your monthly debt payments, divide them by after-tax income times 100, and it's going to give you your debt to income ratio, okay? Let's talk about credit. And so the foundation has put this together to empower people, if you will. And it says credit is a financial asset. So credit is the ability to borrow money to buy something now and pay for it later. When you buy something with credit, you obligate future income. Obligating future income means you're giving up income you haven't earned yet to buy something today. So, looking at a good credit rating could save you approximately $250,000 in interest throughout your working lives. You'll find that information on credit on page 8 of the toolkit. On page 8, it also tells you what a good credit score considers. First of all, it's going to consider your payment history, your track record to pay back your debts, or paying back your debts. It's also going to consider the amount of outstanding debts you owe right now. And when it talks about payment history, that comprises 35% of your credit score. The amount of outstanding debt is going to be 30%. The length of your credit history, credit age, that's going to give you 15% of your credit score. Types of credit, there could be revolving, installment, mortgage, and that's going to account for 10% of your overall credit score. New credit inquiries is going to account for another 10%. So what they use the credit score for is to evaluate risk, okay? And this FICO score that they use to evaluate risk is called the Fair Isaac Corporation scores, become a global standard for measuring credit risk in banking, mortgages, credit cards, auto, retail industry. And so a good credit score, 800, 750, somewhere in that range. It goes up to about 850 and could go as far down as 300. So we want to encourage you to maintain great credit, okay? There are some tips on page 9 for improving your credit score. You want to correct any inaccurate information on your credit score, pay your bills on time. That's a couple of the bullet points there. Correcting errors and omissions, again, follow the instructions are provided with the credit report and send any additional information you have to correct the error. There are 5 C's of credit, and they are character, good personal attributes, capacity, that's your ability to repay, condition, that's your financial circumstances, collateral, and that's any pledged assets you have, and capital or equity investments. On page 10 of the toolkit, you will see the addresses and the names of the 3 credit reporting agencies there for your personal knowledge. Okay, we want to move forward in the toolkit and talk about protecting your wealth. One of the largest areas where people's identities are being compromised these days is in the area of identity theft. So when you want to protect your identity at all costs, protect your personal information. Some warning signs that you could be a victim of identity theft or, regular bills go missing, for example. Mistakes on accounts or your explanation, of medical benefits. A call from a debt collection agency for debts that are not yours. Notices from the IRS. Okay, these are some. And some of the ways to reduce your risk of identity theft are by only providing your social security number as needed. Shredding documents, keeping your mail safe. And there are several other bullet points on there to help you reduce your risk of identity theft. If you are a victim of identity theft, you want to contact one of the 3 nationwide credit reporting agencies. You want to order your credit reports, contact all the creditors involved, file a police report, and you can see the other bullet points there on page 11. We want to talk about some options to costly alternative financial services. One of those options are responsible small loans, And a responsible small loan is going to give you at least a 90-day repayment term. It's repayable in installment versus being due, say, in a 30-day window or a 2-week period. It doesn't allow any personal checks or other unfair collateral, such as a car title. It has reasonable limits on renewals. If somebody's renewing a short-term loan more than 4 times a year, the loans are not helping them. We want to make that clear. And you want to give full consideration of the borrower's ability to repay the loan. So if you're in a situation like that, one of the things you can try to do is establish a payment plan with your creditors. Most creditors, or some rather, will allow you to have a payment plan in place to help you pay any debt that you owe them. And so in a lot of cases, you can get an advance from your employer. If you get an advance from your employer, they do what they call a paycheck advance. And this is a true advance, not a loan, and there's no interest, and the advance is therefore cheaper than alternative financial services loan. And so there are other means of avoiding these all payday services, and you can see some of those on page 13. And you also want to make sure that you avoid those loan fees, and that's what you do when you avoid those financial services, those alternative financial services. And so on page 14, you'll see that information, and on page 15, we greatly encourage you to take massive and immediate action as toward getting out of the alternative financial services loan debt trap. Key thing on page 16 for your reading information is to safeguard your bank account, for sure. And if you're caught in the debt trap, we're going to give you an example in closing here before Carl comes up. We're going to conclude with a story about a businesswoman. And her name was Sandra Harris. Ms. Harris was a successful professional. She worked diligently to keep up with her bills. In a tough time, she turned to an alternative financial services lending. After several rollovers, Harris' first loan was due in full. She couldn't pay it off, so she took a loan from a second lender. Frantically trying to manage her bills, Harris eventually found herself with loans from 6 alternative financial service lenders, including Advance America, Check in the Cash, Check and Go, Urgent Money Express, and 2 online lenders. She paid over $600 per month in fees without any going toward reducing her debt. After writing checks to payday lenders totaling $9,200, she was evicted and her car was repossessed. At the time, it seemed like the way out, but this is not a quick fix. It's like a ton of bricks, said Harris. And so we want to encourage you to do what's hard, which is getting out of debt. If you do what's hard, life will be easy. If you do what's easy, life will be hard. We thank you for your time.
My name is Carl Snell with LPL Financial, and I want to thank you all for attending this presentation. And as my colleague Willie Bell said, it is our desire that you will take from this presentation some ideas to better your financial life, the financial life of your loved ones, and the people around you. So who are we? First, we're supported by LPL Financial Corporation, one of the largest independent broker-dealers in the United States. We are investment strategists with 30 years combined experience in the arena of financial services. We have counseled literally thousands of people over the years in the area of budgeting, debt reduction, investment and retirement planning. We love sharing ideas and feel we will empower you financially if you put some of these ideas into practice. So what do we want to talk about today? Basically, we feel there are 7 steps to achieve a healthy financial life or to be on the path to a better financial future. So what would those 7 steps be? And I'm going to read through them real quick. Number 1, dream, set goals, and take action. I believe Mr. Bell referred to that earlier in the presentation. Dream, set goals, take action. Number 2, you should consider having the proper amount of life insurance in place. That is the foundation. Number 3, emergency fund. You should have dollars, this is dollar sign, money in the bank in case of emergencies. Why is that? We know emergency will happen where we will need access to cash. Number 4, learn to live within your budget. Simply put, don't spend more money than you make. Number 5, pay off all debt using the debt snowball method. We'll talk a little bit about that further on. Number 6, invest up to 15% or more of your income into Roth IRA or pre-tax retirement accounts. And number 7, pay your home off early. So what are our course objectives? We want to teach you how to work toward becoming financially independent through establishing written goals for your finances, again, managing and ultimately eliminating debt, develop an investment strategy, and work toward protecting your current assets. Many people die at 25 and aren't buried until they are 75. This quote is attributed to Benjamin Franklin. And in my opinion, even then, Benjamin Franklin realized most folks stop dreaming at 25 and are somewhat settled into the life that they're going to live for the next 50 to 60 years. This presentation is being produced for employees of school districts in Mississippi, Louisiana, and Arkansas. So at this point, I would just like to ask the viewers a question. Prior to becoming an educator, you had an idea of the courses you had to take to become an educator. Am I correct? Yes. For those of you with specialty degrees, prior to receiving, let's say, a master's degree, you knew the courses that you had to take prior to entering school to get that master's degree. Do you all agree or disagree? I think most people will agree. The same comes with setting goals and dreaming. You must first see yourself in that position. See yourself living a healthy financial life. Set a goal to achieve that healthy financial life, and then take action moving forward. So you need to dream it, see it, set that goal, write it down, and then move forward. And so some benefits of setting goals are, goals help you establish a direction for your financial life. With goals, you can track, you can also identify results. Goals challenges you to grow. Do you all agree with that? Goal settings improve your self-image. Goal setting also gives you confidence, especially when you achieve a goal. Goals force you to be specific, okay? Prior to receiving that degree, you had an idea of the graduation date, right? Prior to enrolling in college, you pretty much knew that course that you had to take, correct? The same with goals. The same for your financial life. Set goals, dream about it, take action. And then we say here, with goals, you'll be forced to take a more active, disciplined role with your finances. So, life insurance was one of those steps in that 7-step process. In my business, I often get the question asked, do I need life insurance? And my answer is this: if there's anybody, if there's anyone that depends on your income, and if that income is taken away, if they will be negatively affected, if your answer to that is yes, then I would say you need life insurance. So then the next question would be then is how much life insurance do I need? Most investment and insurance professionals suggest that a person has 10 times their salary in life insurance death benefit. Okay, let's take a look at this example. Okay, this is a monthly income from life insurance proceeds with a 6% withdrawal rate. Let me say this is a hypothetical example, and it is not representative of any investment. Your results will vary. Okay, with that being said, say if a person had $100,000 worth of life insurance. And by the way, if y'all would like to receive a copy of this, we can make that available to you. You can email us and we'll send you a PDF copy of what we're presenting here today. Let's say a person had $100,000 worth of life insurance, and God forbid something would happen to that person, and the survivor would be left with the $100,000. Let's take a look at that. If a person invested that $100,000 and received that hypothetical 6% return, and let's say they never touched the principal, the original $100,000, and they received 6% off of that $100,000, how much would the survivor have to live off of? At 6%, how much is that per year? All you do is 6 times 100,000, that equals $6,000 a year, or $500 a month. So my question to that person would be, could your family survive with an income of $500 a month? Some people will say yes, some people will say no. So let's move on down the chart here. Say if a person is earning $33,000 a year, that individual, based on this hypothetical example, would need $550,000 worth of life insurance. Why is that? 550 times 6% is $33,000. $33,000 translate to $2,750 a month. This is the foundation. This is the key. That when you set that goal, and again, God forbid, you're not able to live out that goal with your family and you're taken away, that at least the survivors will have a fighting chance of living a comfortable life after you depart. Sorry to get morbid on you, but it's a fact. We need life insurance and we need the proper amount. With the emergency fund, we suggest that you set aside $50 to $100 per month until you have an amount that you feel is comfortable for you. Each individual needs are different, but one thing is certain, an emergency is going to happen. The car radiator will need repair. You will have a flat tire. The transmission will go out. You will need another central unit. It's going to happen. Just wait. So it's very important to set aside a comfortable amount for emergencies. Not in case they happen, but when they happen. Do you all agree with that? Okay. Have the proper amount of life insurance. Then next, start working on your emergency fund. So how much do we say set aside each month? Really, it's going to depend on how much you can afford, but it's suggested $50 to $100 a month, and some of you all can even afford more. Live within your budget. So what is a budget? A budget is an organized list of your sources of income and the money you spend on essentials like housing, food, fun things like going out to dinner and a movie, and what you need to save for the future. Just like using a map to reach your destination, budgeting is a tool that helps you realize your financial goals. It can help you navigate through those moments when you experience financial difficulties. And let me say this, you will experience financial difficulties. You can take charge of your finances by setting financial goals, planning your budget, and sticking with it. So I think my colleague Willie Bell went over some budget guidelines. We're going to revisit that with a slide right now. So let's take a look. So we see on our budget list, it has number one, your net pay. How much money do you have coming in? Then you have a slot for other income. And then you have the total of all your income. This is what I found out, is that a lot of people really don't know how much money they make or have coming in until the end of the year. Because with the advent of direct deposit, a lot of people don't even check their statements or their pay stubs. Hopefully that's not the case here, but again, we've counseled thousands of people, and this is something that we found to be true. So the first thing is know how much you're making. The second column is your expenses. Know how much your rent and mortgage is, your utilities, your cable, telephone, internet, cell phone, transportation, and then it has a column for others. Now, let's look at this budget by categories. I love this sheet because it gives numbers. So it says a person, the housing budget. What's the maximum amount that a person should be spending for housing? Based on the illustration here, it's 32%. So if you're making $2,000 a month, you just times that times 32, and if you're spending over that amount, you might need to make some adjustments somewhere, okay? Auto, 15%. So, same calculation there, very simple. So just take this, the budget plan by category, figure out how much money you're making, okay, your net income, and then use these percentages and sort of figure out where you are, okay? Debt guidelines, I think you all could just sort of look at that and read that because the debt guidelines and the monthly budget and the percentages that we just went over are pretty much the same, okay? Now, pay off all debt using the debt snowball. So let me just sort of define what debt snowball is first, and then we'll talk about it a little bit more. The debt snowball method is a debt reduction strategy whereby one who owes on more than one account pays off the account starting with the smallest balance first, and while paying the minimum on the largest debts, once the smallest debt is paid off, one proceeds to the next slightly smaller debt above that, so on and so forth, gradually until all debts are paid. Now here, the name of this particular client is Mr. and Mrs. Forever in Debt. Have anybody ever heard the people say, well, you know, I've always had a car payment, I always go debt, and I'll never be out of debt? Have anybody ever heard that? Well, I have, and I hear it plenty of times. But the person pretty much have decided that they're going to be in debt for the rest of their life. But for those of you that would like a strategy to get out of that debt, that's what we're going to talk about. So what I have here, I have a list of 8 debts that Mr. and Mrs. Forever in Debt has. The first debt, the balance is $530. The interest rate is 26.9%. The minimum payment is $20 a month. They're making their payments on time. They have great credit. And the current debt is $521. And so what we do is we add all of these debts up and all of the monthly payments up. And it comes out where Mr. and Mrs. Forever in Debt owe roughly $39,380, and they are paying $714 a month. And guess what? they don't know when they'll be out of debt. So the bill comes, they write out the receipts and send the check off. Or with technology today, they go online, log on, make the payment, and it's done. But some of you out there would like to know, how can I get out of debt quicker? So let's talk about that. Looking at this same illustration, if they paid an additional $110 per month, which would pay a total monthly payment of $824, which would be the new monthly payment, they'll be out of debt in, let's say, about 50 months, okay? So you go from a time of, I don't know when I'm going to be out of debt, to knowing, having a goal, you've dreamed about it, you've written it down, you've taken the action, and you're executing, and now you know you'll be out of debt in 50 months, thereabout, okay? And to me, that's exciting. To be out of debt in 48, 60 months, even 120 months, to have that goal and work toward it and achieve that goal, it makes a difference. It'll change your life. It'll change the life of your loved ones, and it'll change the life of your friends and the people around you. And you have a better outlook on your future, and you have more self-confidence. Take it. It's true. Invest. Here are a few examples of what you can potentially invest in. Number one we have listed is employers' retirement plans, such as 401ks, 403bs, simple IRAs, SEP IRAs. You also have traditional IRAs that you can invest some of your income in, retirement dollars. Roth IRAs, mutual funds, and real estate. And so after you have that proper investment plan in place, you want to pay your home off early, just think about it. $39,000 of debt, and it's everything except the mortgage. You're out of that debt in 5 years. And now that money you can add towards your home to get it paid off early. So that 30-year mortgage that you had, you probably can cut that down to about, and this is just total hypothetical off my mind, maybe 10 to 12 years. It can be done. We believe that giving is the key. All good things will come back to you as a result of your giving. I feel it's a basic law of nature. So you can give of what? You can give your time. You can give of your resources. And also you can give of your talents. So, when is the time to get started? We think now is the time. This is the moment. This is your destiny. With an effort here. We appreciate you all watching this. This is a part of your destiny. The next thing you have to do is just do it. If you'd like more information, you can contact us. My name is Carl Snell or Willie Bell. Our office address and our email addresses are listed. Shoot us an email. We'll be happy to talk to you.